The first full trading week of 2020 is coming to a close, and joining us now to discuss the markets and his outlook for this year is Barry Knapp, Ironsides, Macroeconomics managing partner. So, Barry, looking at your note here about the three tailwinds, and you have this idea that you expect a risk-on investing environment, and then, I love this, you say until April or May. Right. Fantastic. You told me when it's going to stop. Why? What's going to happen in April or May?
Yeah, that's been one of the approaches I've tried to take over the year is if you pin yourself to at the year end, the price target will be, that doesn't help you all that much, right? I mean, because rarely do we just move in a straight line through the course of the year. Even last year where we had 29% returns, we didn't get straight there. But the way I'm thinking about it is as follows. One of my tailwinds is the monetary policy accommodation the Fed says is not QE. But as we know, the very definition of QE is you buy treasury bills or you inject reserves into the system, like Japan did in 2001 and so forth. Around about April or May, the Fed will be considering ending that program. They will have gotten bank reserves to a level where they think that we're now in an ample reserves requirement, and they'll be considering it. And if you go back and you think about the launch of QE2 in the fall of 2010, and then what happened in 2011, or when the Europeans launched sovereign QE back in 2015, and then what happened when you get to that first significant earnings season after the program's been in place, equities undoubtedly have had a pretty good move. Yes, earnings are likely responding because the Fed's a lagging indicator and tends to ease into an improving environment anyway. But the share prices are generally ahead of core fundamentals. These programs don't really do all that much for macroeconomic growth. So around about April or May, we'll be reporting. The stock market will have had quite a run. The market will accept the fact that, yes, earnings growth is going to rebound this year to something closer to 10%, but that'll be fully discounted. Yeah. Now we have what I call a Fed monetary policy normalization-related correction, or Fed correction. Every business cycle since World War II has had one. This business cycle, has had 8, right? And most of them are related to the various QE programs. So what those corrections look like is something like an 8% pullback, subject to a couple of percent standard deviation around that. They last for about 6 weeks. The market realizes, well, this isn't terminal for the business cycle or for the bull market advance. Market stabilizes, recovers, trades in a range for a while, and then moves on. And in this case, it also coincides pretty well with the presidential cycle. Because round about then, we'll be deciding who is the Democratic nominee. And even if we get one of the more centrist candidates, they're going to have to try and excite the base. Well, exciting the base means talking about all the taxes they're going to hike.
So, I mean, I guess, though, the kind of the short answer here is, like, the only thing that matters is the Fed, right? All we need to know is kind of where the Fed is at, and that gives us like 80% of the equation.
Well, it gives us a lot of the equation in terms of timing, but what also matters, my other tailwinds are, we are going through a recovery from the global manufacturing and trade recession, right? Trade contracted last year globally. Growth didn't contract globally, right? So we overshot. That recovery has begun. You've seen it in some of the numbers. Taiwan was the latest.
And do we need a trade deal for that to happen, Barry?
Well, the trade deal stabilized it, for sure. My perspective on this was there's a stock and a flow around trade, meaning, yes, some of the tariffs are going to remain in place, and we're going through a secular trend away from, globalization. We're in a deglobalization, longer-term trend. But no new tariffs meant that business confidence could stabilize, here and in China and otherwise. So now that you've gotten the deal done, or at least gone into some sort of detente, then confidence rebounds, capital spending rebounds, manufacturing production picks back up. Even Germany showed better IP numbers this morning, back in November. So those fundamentals do matter a lot. You kind of need, monetary policy could be easing at a point when fundamentals are going south. And it wouldn't matter.
Is that what drives earnings growth? Because 10's kind of on the aggressive side, given what we've seen over the past couple of years,
well,
right?
we got 24 2 years ago.
Yeah.
We got 2 last year.
Right.
Put them together.
And then, so that's your mean?
You're sort of mean. And the reason I come up with that mean is the long-term mean is 7% or so, right? But that includes recessions. if you look at the business cycle and you take out the recovery period and when you're going into a recession and assume that neither of those things are going to happen in 2020, the trend is more like 11 or 12 within a business cycle. It looks like revenue growth will be back at 5% or so. That's a level that means you have positive operating leverage, and you should get back to something more like 9 or 10. And this cycle, earnings growth has been a little below that long-term trend because nominal GDP has been softer and revenue growth has been a bit softer. So all I'm saying is, yeah, we get revenue growth back close to 5. We should have earnings growth around 9, and that's the recovery. And I realize I'm sort of splitting the 2 years, but in reality, that's kind of makes sense. I mean, because a lot of the weakness last year was attributable to how difficult the comps were.
The comps because of the tax cut that goosed the numbers.
Well, remember, the tax cut wasn't the whole explanation for that 24% number. That only really boosted it by 7 or 8.
Yeah.
The rest of it was an acceleration in growth. Right.
Interesting to think about the calendar this way.
Yeah.
April or May, we've got
sell in May and
marked.
go away.
But then what's interesting then, too, is you get to a point where the sector rotation opportunities present themselves because we get into that election period and we're going to be talking about Medicare for all and fracking for no one, right? So those two sectors could come under extreme pressure. Yeah. Those were on my list of long-term secular themes. More productivity in the healthcare sector. Energy isn't going away. We're still going to need fossil fuels, and we're going to have more stable cash flows. Your last guest was talking about oil being globally priced. Yeah. The missing piece, though, is the elasticity of supply has changed dramatically. You can get a new well fracked in 3 weeks. It used to take 3 years to drill one in the Gulf, right? So that more stable cash flows in energy will make the sector interesting. Easy for me to say, interesting. But were those sectors to get really hammered in that April-May timeframe, that would present a pretty interesting opportunity.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.